Now, Stephen, by the way, is an academic, but I'm not sure that he's an academic at all, right? Because
I'm
he
still
doesn't
an
live in
academic.
an ivory tower. Because based on what I know about him, he's extremely into, the real problems of society. He's extremely into public services. So, your point of view, Stephen?
Thank you, TC. We have been talking about a crisis this afternoon. The current situation reminds me of two movies. Maybe you guys are too young to remember these two movies. The first one, The Perfect Storm, and the second one is The Day After Tomorrow. I think the question that we need to ask, don't laugh, I mean, the question we need to ask is what our financial market will be after the crisis. In my view, there will be a couple of points, there will be a couple of changes that we're going to see in the financial market. In general, the future financial market will be very different from the financial market that we see today. First point, the investor has become very risk averse. And as evident by the proportion of increase in bank deposit and cash holding. Today, the crack of the market is cash is king. So people want to hold cash now. They don't want to invest in risky assets. This is the first point. The second point is the regulator has become very cautious. I think in the future time, they won't approve any product that they don't understand. But given the fact that these regulators are either lawyer or accountant, so I think the numbers of product or new product they're going to approve will be very minimal. So that implies the financial innovation and financial engineering, that the speed we see this area are developing in the old days is going to slow down. And the last point, the way I look at it is the business model of investment banks or financial institution has to change. So changes are going to see in the staff incentive model and also the way they sell their product. So I think these are the changes that we're going to see in the financial markets. So in order to prepare yourself to get a job in the financial market when you graduate, you have to notice these are the change. So the old days were gone. So we are going to see a new financial market. We still need bankers. We still need people who work in the bank, in the investment bank, commercial bank. There will be jobs there. But the way to run these institutions are going to be very different.
That's a good point, Stephen. So besides the negative effect of deleveraging, you also pointed out something that's extremely important that will also affect the financial industries, in negative ways, and that's much tighter regulation. But I agree. That's another dimension that we have to be very careful about. Now, David, by the way, was only introduced as the vice chairman of Schroders Investment Management. But for those of you who don't know David that well, he actually spent 10 years, right, working and living in China before he retired and came back to Hong Kong. So he is a unique resource, I would say, among financial professionals, who have the hands-on experience of working in that very important emerging market. Now, the question related to what we just said, but very specific to China, that I have for you, David, is in this whole crisis, China seems to be relatively unscathed, right? It has done quite well, despite, of course, the drop in export, which is not financial markets related. Why is that? And what do you see as the future of China? Is it going to emerge much stronger, as some people predict, the so-called redistribution of power, or is it going to be in some day, also, to be suffering, from the fallout, right, of this global crisis, David?
before I answer this question, I just briefly add to what Professor Yang said. I think from looking at the point from the investor point of view, because we are in the financial service, we are providing service to the institution in individuals. What the individual, especially from us from the fund management industry side, is there may be even more emphasis on away from equities and concentrating more on fixed income investments. There has been a change early on in shift of emphasis in the 1997-1998 crisis and also the year 2000 when the stock market fell. And pension funds, I think especially in the Western countries, in US and Europe, especially those relying on defined benefits, move away, reducing the equity contents and increasing the bond holdings in their portfolio. I think now the financial, with this financial crisis, even more pointed towards that we need to look at the investment in bonds as the percentage in our retirement portfolio as a protection against the volatilities in equities, especially having seen equities shareholders more or less being wiped out, and government are not going to defend or protect any equity holders in any problem taking into financial problems. And now maybe even bond, looking at the GM things, that may also call into questions. So I think investors will become more and more defensive and conservative in their approach, rather than going for high risk things. And company will have to change accordingly. The question I come back to TC's question is why China at this point of time, is much better than any of the Western countries. First, because China is not an open economy, open markets. It is a very closed market. Investors cannot invest in overseas market, as you know, only through nowadays more recently in QDII. But obviously, a lot of Chinese people have overseas investment. But for the majority of the people in China, this is not an open market. And also, overseas funds or service providers cannot sell exotic products into China. They are very, very well protected. In China, at the moment, there is only bond fund, equity funds, guarantee funds, money market funds, and so on. No really structured products yet. No derivative products. And also the China, because in year 2006 and 2007, they already think the market is overheated, the economy is overheated, market is overheated. So they have tightened much earlier than other countries, while the US still moving up. So I think because the government have taken measures earlier to reduce the risk, whether it's in the stock markets, and also, despite the stock market came off sharply, but in actual fact, in China, they clamped down the issuing of funds early in year 2008 already. Apparently, last year, nobody, or even in the second half of year 2007, and not many people managed to launch funds in year 2008. And also because of the huge surplus China have over the years, because the export drive the concentration of export. And then they enable them to weather this storm much better, and also be able to push the economic growth through fiscal stimulus and monetary stimulus.
Okay, thanks, David. So the important take that I have from you are one, bad news. Nowadays, for equity traders, equity salesmen, and maybe also to some extent, for fixed income, particularly the mini bonds, right? The exotic fixed income salespeople and traders. And secondly, free market is bad, right? China does not have a free market. That's why is doing relatively well.